Good morning, everyone. Welcome to this update for global stocks and commodities for the 28th of October. It's been a very poor month, obviously, as everybody would know, and it's close to the worst that we've seen since probably 2009. And when you get periods like this, emotions take over, and suddenly all that most people, and especially the commentators, can see is the end of the bull market. And stocks just completely falling off a cliff, and we're certainly seeing plenty of that at the moment. But look, let me pound the table and say that this is setting up one of the best investing opportunities of the decade, in my opinion, but not necessarily in the indices. I think it's too early to say where the indices are going, because they're obviously comprised of a very wide variety of different stocks. But going forward, I believe that it's going to be even more critical on the stocks that you select, and also tactics as well are really, really important. But I really think that in some parts of the market, you're going to get opportunities that we've been starved of for the last 3 to 5 years, and that's a good thing. But look, even if I'm wrong, and this does prove to be the ultimate top in the market, and the 9 or 10 year bull market, depending on how you want to count it, is over, and this is the ultimate top, then there will be some spectacular rallies as well as declines along the way. And if you have any doubt about that, then please go back and look at the video that I did on October 14, so just 2 weeks ago. And I do this 3 or 4 times a year. And I went back and I looked at what the S&P indices look like in 2000 and 2008. And I think that'll put this current decline into perspective about what we can expect going forward. Whether this is an ultimate bull market top or not, it doesn't really matter. We're going to get spectacular rallies no matter what. You also might want to look at the video that I did last week, where I outlined the essential precursors for basically the start of every bear market, and none of those are in place. And that's why I don't believe that this is the end of the bull market. I believe we're still going to have one more phase to the upside that could potentially last several years. But look, either way, there will be spectacular rallies, and that creates opportunity. Technological advancement is not dead. We see it all around us with the Internet of Things and driverless cars and 5G technology, and it's just, the list goes on and on and on. So technological advancement is not dead, but it's just we had a situation where a lot of stocks, particularly the FANG type stocks, rose a great deal, and now they're correcting. Well, there's nothing unusual about that. That's not a big deal at all. And yet people seem to be extrapolating that to the bull market is over. And I just think it's too big a stretch at this stage. But look, there is no question that this is a change of character in the market. We had a great run. And the question is, what is it changing to? Is this a reaccumulation before the next move up, albeit a fairly volatile one? Or is it actually a full-blown market top? And it's just way too early to say. So just ignore the people that want to make a prediction about where this market is going. And the final point I want to make is that even in bear markets that go on for a year or 18 months, some stocks rise, and rise very strongly. It's just there's not that many of them. When we're in a bull market, most stocks are going up. When you're in a bear market, some stocks still go up. So please don't lose sight of that particular fact. All right, so let's jump into it. So in this update, I just want to paint a bit of a picture of what to watch out for. But again, I stress it's too early in the process to be definitive about short-term outcomes. But the overwhelming odds, in my view, do not favour a bear market, and for the reasons that were outlined in the last 2 weeks' videos. So, please go back and look at those if you have any doubts about that. And those that are calling a major top to the market have been doing so for 5 or 6 years, and they're just guessing. That's the long and the short of it. We'll be looking at the stock and commodity trend update, of course. And last week in Portfolio Analyst, I looked at precious metals, and there were a lot of questions from members about precious metals as well, particularly in Australia. And some good trends and some good opportunities. So let's get into it. The S&P 500 was hit very, very hard, was down 110 points on the week, and all the main US indices are now sharply below their 200-day moving averages, and many stocks are down by 20% plus. So the S&P, I think, is down by 9% or something of that order, but there are so many stocks that are down by 20% plus, and they're the high flyers, the ones that have, maybe gone up 100% to 200%. And the fact that they're now down 20%, I don't find anything particularly unusual about that. That's just pretty much what you'd expect. So, just don't read too much into it when the commentators are trotting out these facts and figures. Now, this is shaping up as a typical correction. It's done a lot of technical damage. There's no question about that. But as I covered last week, the 4 key things that you look for in a bear market, 3 of them fundamental based, 1 of them technically based, are not evident, and they're not on the horizon at this stage, particularly the fundamentals. But look, even if I'm wrong and this is a major top, and we won't know that for 6 months at least, then a powerful rebound is coming if you wish to reduce exposure to the stock market. So don't panic and sell out now. There will be a powerful rebound coming. And again, if you have any doubt, go and look at the video from 2 weeks ago and just see what happened around 2000 and then what happened again in 2008. We got 6 months warning and about 3 opportunities to get out in 2008, somewhere pretty close to the top. So, don't panic and dump everything at this stage. The US dollar was higher on the week, and so let's jump in and take a look at some charts. So we'll start with the S&P first of all. In fact, let's just start with a monthly chart. So you can see that this is the month isn't quite done yet. There's a few more trading days, but you can see that quite clearly this is the worst month that we've had for a long time. You've really got to go back to the GFC to see a plunge of this sort of dimension. And so it's not unexpected that it's making people extremely nervous and fearful when you get this sort of activity going on, but you've got to keep it in perspective. So as distinct from what we saw in February, which was really coming off a short-term blow-off top in January, but that didn't breach, and neither did the subsequent decline, didn't breach the 200-day moving average. This time we've breached the 200-day moving average. So, this is a more significant change of character. But this could still be a big, broad reaccumulation range. And I think that you've got to stay with what is, and at the moment, until we get a break of the swing lows. So let's assume for a minute that this is the low point. I got my doubts. I think there's more selling to come yet in the short term. But let's say that this is the low. Now, we'll get a rally out of this to a lower high, possibly even a higher high. But the line in the sand would then be when this swing low gets taken out. Now, I've covered all this in the video in detail 2 weeks ago. So I'm not saying this is the low. In fact, I don't think it is. I think there's every chance we could end up down below 2,600 points and perhaps retest the lows of February. But there will be quite a sharp rally, I believe, in the not too far off time frame, and this is going to chop around for a while. That's for sure. Let's look at the Nasdaq via the QQQ, and you can see the Nasdaq, which didn't manage to reach its 200-day moving average in February and April. Certainly has this time. And it was a fairly weak and brief rally, really only one very positive day, and then it just went straight down again. So that's why I'm expecting lower prices, because this little rally here was so weak and so brief that it sort of, defines logic that there's not a lot of selling pressure, and therefore there's more to go yet. So you've got to understand what creates these downdrafts. It's the institutions deciding to to pull back from the game that's been played now for a number of years, and they can't sell overnight. They try and offload as much stock as they can up near the top. So they would have been distributing stock up here. But once the prices start to break to the downside, they've still got a lot to get rid of. And depending on how committed they are to reducing their holdings in these higher technology stocks, then the deeper and longer this will play out. But the fact that it was such a brief little blip in price strongly suggests to me that there's more selling yet to come. So we're not necessarily to the great buying opportunity yet, but it is rapidly approaching. And let's look at the Russell. So the Russell, which was leading the way, it was outperforming all the other indices up until really here, I guess, or probably here in August. And you can see just how dramatically the Russell small caps have fallen apart. So that's not a particularly great sign. That does give me a little bit of caution, I must say. Okay, US dollar strengthened again during the week, and you've really got to say that we're just building a platform here for another rise, and I think it looks likely that the US dollar is probably heading back towards 100, and that of course will take the Australian dollar down. And while we're here, let's just look at the Australian dollar. So we had a little bit of a jump on Friday with US dollar weakness, but you can see there's just nothing has changed in the downtrend on the Australian dollar. We're still clearly in downtrend, and the next support comes in at about 68.4. Now the ASX 200, of course, didn't escape. Got hit very, very hard, and we're now clearly back down, approaching some important support levels. So these were the peaks. This was the peak in 2015 that we couldn't get through. We then had repeated attempts to break out. We managed to break out, reached a high of just a little bit under 6,400 points, but now we've collapsed back again to 5,600. So down 800 points since this selling started, and that is so sharp that I think we could well be, back down in the low 5,000s for probably for some period of time, particularly if you look at where the likely direction of the major banks. It's hard to see the ASX 200 being able to pick up any momentum. Okay, just quickly, Aussie Stocks 71 on the Australian dollar. 274 was the official decline on the ASX 200. And look, pretty much everything got sold, and so many stocks closed the week on their lows or close to their lows, which just sort of begs more selling next week. But start getting excited by what is building, because whether or not we've seen a major top in the US market, I don't believe we have. This is still going to be an opportunity to pick up some great stocks, and I'll come back to that point shortly. The high-quality growth stocks that were formerly very expensive, that the market had been punting up, are now rapidly coming back into a range that's more reasonable. For them, their businesses haven't changed. It's just they've had 25 or 30% or 50% clipped off their stock price, but the business is unchanged. So you've got to remember to distinguish between those two things. Just because the stock price has fallen in half doesn't mean that the business is all of a sudden doing worse. It's just the prices come back down again. And then there are the formerly modestly priced growth stocks that have perhaps got even a little bit cheaper, but they've been resilient. And I've been covering a lot of these in Portfolio Analyst, and this is really going to be the happy hunting ground. So that's the Australian market. Let's look at precious metals. Gold was up again a little bit, up to 1234, and we've got this scenario now where the gold is rallying despite the fact that the US dollar is going up as well. So that's why I'm still a bit more positive on the precious metals sector. Now, GDX, which is covering the global gold stock majors, actually didn't have a good week, which was a bit surprising. So it sort of went the other way a little bit. And that concerns me just a little because gold stocks do tend to lead the price of gold. GDX was positive early. We saw some good gains early in the week, and then it got absolutely smacked on Thursday. So I'm not quite sure what to make of that. But at this stage, it's just one session. So I'm looking for some more information there. So let's just look at gold. So this is gold on a weekly basis, and you can see it's been rallying up. We were trading down around the 1180, 1190 area. We're now up to 1235, and that's during a period when the US dollar has risen. So, that's an important change for gold. And GDX. So this is a weekly chart, strong early, and then hit hard on Thursday. So GDX still can't get out of its own way, but Australian gold producers are trending very, very nicely. So that's the gold market. Copper steady at 281. Don't forget the inventory trend. I showed you that over the last couple of weeks. I'll just put that up again as a reminder in a minute. West Texas Intermediate crude fell again to 67.6. And these are just fluctuations in inventory and geopolitical issues that wax and wane all the time. So I believe the long-term trend upwards for crude oil and a resurgence in energy stocks has not changed. It's a volatile sector. You certainly don't want to be chasing it to get in. You want to buy on weakness. You want to buy when nobody else wants to. And I think you'll probably do okay out of the energy sector. There's the spot copper chart, so you can see not much change there since September. And this is the inventory level for copper. So inventory levels continue to plummet, and they have been, as you can see, all year. And if we look at the 5-year chart, which I've done a couple of times in recent weeks, you can see that we're now down to almost record lows in terms of copper in the warehouse. So at some point, unless demand absolutely falls off a cliff, and there's no real indications of that yet, then the copper price has got to pick up, and that's going to be positive for copper and other base metal stocks. There's a crude oil chart, so we've come all the way back down from 76 back to 67. Lost about $9, but it hasn't really changed the big picture trend from my perspective. Now, this is what I put up last week, the next 2 or 3 lines. A changing landscape dictates a shift in methodology, so there's no question that you need to tread very warily with the companies that have done extremely well over the last couple of years. In Australia, I'm talking about stocks like WiseTech Global, Altium, Appen, Afterpay Touch. There's quite a long list of them. You can't trade them like we did over the last couple of years and just sit back and expect to make great gobs of money. It's not going to happen. So you do need to shift your methodology, but it doesn't mean that you can't make money out of those stocks and a lot of others. But I'm seeking opportunities where risk is far lower, but where strong growth is still occurring. And again, you've got to remember, even in a bear market, businesses are still growing strongly or can still grow strongly, and they're the ones that we want to focus on. I mentioned last week that there were 2 types of opportunities where that combination occurs, and I spend a great deal of time in Portfolio Analyst and my other services in talking about those 2 opportunity types. As I said, we're now approaching one of the best investing opportunities of the decade, but what and how you go about it, so the tactics that you apply, is critical. This is not a market where you can just march in and and buy any old time and sit back and expect to make some gains. I think that sort of market environment is gone. I would strongly urge you to resist the urge to project one poor month, and this month has been a shocker, but don't project one poor month to an overall bad outcome. Like, we're going to get this protracted bear market, and if you're age 65 or above, all of a sudden you're slitting your wrists because you're going to run out of money. That's just, don't do that, because it's just totally inappropriate. It's at this stage, it's just one poor month, and I'm still firmly in the camp that we're going to see new highs in the market when this phase plays out. But even if we don't, even if the market rebounds to a lower high, there'll still be a good opportunity to get out under better circumstances than what we've got now. Portfolio Analyst this week, it's all about stalking the great setups, and there are a lot of them that are already in place. Now, they're not necessarily buys yet, but there are terrific businesses that are now a lot cheaper than they were, and I'm happy to buy them from a valuation perspective from anywhere here down. I'm just waiting for some price stability. So in general, what I'm seeking, let's call it in inverted commas, the ideal stock. So this is what I'm spending a lot of time on. I think there's a good chance that the growth stock binge is over, and valuations are now becoming even more important than they were. And as a consequence, I've been conducting just a huge amount of research, looking for companies that fit this ideal stock definition, if you like. So this is what I look for: high earnings visibility because of, and there's a number of things, but they may have a strong niche in a global market due to intellectual property or something of that nature. They also have a high level of recurring revenue, is another way to get very high earnings visibility. But I'm not taking anything to chance. I want to feel extremely confident that the companies I invest in from here on in are going to have strongly growing earnings, 20% a year and above, and that is highly likely to come to fruition. The second thing I look for is companies with strong free cash flow and limited debt, because that allows them to do all sorts of things. They can grow their business organically. They can acquire other businesses that get into trouble. There is no substitute for strong free cash flow. I'm looking for earnings growth above 20% for the next 2 to 3 years, and of course, as above, with a high degree of probability or visibility. And I'm also looking for valuations that are close to a base in the typical PE band. So different stocks and different sectors tend to operate in bands. If you look at the banks and financial stocks, they tend to operate in a PE band between, let's say, 9 and 16. When the market is very bullish on banks, the PEs will be up around 16. When the market is very negative on banks, you'll find the PEs closer to 8 or 9. You could apply that to virtually every sector. So I'm looking for stocks that are trading close to the minimum sort of PE level that they normally get to, and that then reduces our downside risk. I'm then looking for a meaningful sell-off in price. So I don't want to have any sort of potential profit-taking overhang. I want to have all that cleaned out, and that's what we're seeing right now, and that's why I'm excited about the opportunities. So that's it for this week. I expect more selling, so this is not a time to be a hero, but I also expect some terrific opportunities setting up. There's my contact details for any non-members, and I think there's a lot of very, very good and useful perspective in Portfolio Analyst. So if you haven't tried it, then please do so. I think you'll get a lot of very valuable information. That's it for this week. Cheers.